Lehman Brothers was founded in Montgomery, Alabama in 1850. The firm survived the Civil War. It survived the Panic of 1907. It survived the Great Depression. It survived 2 world wars. It survived the 1987 stock market crash. It survived the Asian financial crisis of 1997 and the dot-com collapse of 2000 and September 11th of 2001, when its headquarters in the World Financial Center were rendered unusable, and the firm was operating from a hotel in Midtown 3 days later. In its 158-year history, Lehman Brothers had survived roughly every major financial event that occurred in the modern world. On Friday, September 12, 2008, Lehman was the 4th largest investment bank in the United States. It had $639 billion in assets, 25,000 employees, and a Wall Street footprint going back 5 generations. By Monday morning, September 15th, the firm was in Chapter 11. The largest corporate bankruptcy in American history had been filed over a single weekend. This is the channel's second Moment Decisive case, and it is the most honest version of what the framework means when it names moment as the cause. Quick recap. Every company is shaped by 4 forces: market, the conditions they operate in; money, how they're funded, and what that costs them; management, the decisions made at the top; moment, the timing and events they didn't choose. All 4 are always present. Only one is decisive. 3 episodes ago, Nokia was named as the channel's first moment case. A slow moment, played out over years. Lehman is the second. Same force, different speed. The investment banking industry in 2008 was healthy by most measures. The 5 major U.S. investment banks, Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns, had all reported strong earnings through 2006 and most of 2007. Mortgage origination, securitization, prime brokerage, and trading were all generating record profits. The market did have a specific concentration that mattered. By 2007, all 5 firms had built large fixed-income operations centered on mortgage-backed securities and related structured products. Lehman had a particularly heavy commitment. Its fixed-income business, including a fast-growing residential and commercial mortgage origination operation through subsidiaries like BNC Mortgage and Aurora Loan Services, was the firm's profit engine. When you ran the numbers in 2006 or early 2007, the mortgage securitization business looked like a great market. Yields were attractive, default rates were historically low. The credit rating agencies were rating most of the senior tranches AAA. Demand for the product was insatiable, particularly from European and Asian banks looking for dollar-denominated yield. What this market description misses is that it was a market built on a specific assumption that U.S. housing prices would not fall significantly across the country at the same time. There was no historical precedent for a national, simultaneous housing decline. The model's priced for regional drops, not a national drop. So when housing prices started falling in 2006 and the decline became national in 2007 and 2008, the market's foundational assumption was broken. The market was profitable on the surface and structurally fragile underneath. That fragility was visible to a few people. Short sellers like Michael Burry and Steve Eisman saw it, but the broad consensus held that the structure was sound until the moment it stopped being sound. Market, superficially healthy, structurally fragile in a way few firms had priced for. Money is where Lehman's specific vulnerability lived. Investment banks are leveraged businesses. They borrow short and invest long, and they carry assets many multiples of their own equity. The question is always how much. At the end of 2007, Lehman's reported leverage ratio, total assets divided by tangible equity, was approximately 30-1. That means for every dollar of equity capital the firm had, it held roughly $30 of assets. A 3% decline in the value of those assets would wipe out the equity entirely. For comparison, a normal commercial bank ran at maybe 10-1. The other major investment banks at the time ran between roughly 25 and 33-1, so Lehman was within industry range. But at the high end, and with a disproportionately large share of its assets in mortgage-related securities that were about to be repriced sharply downward, Lehman also had a specific funding structure that mattered. The firm relied heavily on the repo market, short-term borrowing collateralized by securities, much of which had to be rolled over every single day. When confidence in Lehman's collateral dropped, the firm's overnight funding became expensive and then unavailable. There is no slow death from a repo market failure. Once counterparties refused to lend overnight, the firm had hours, not weeks, to find a buyer or a backstop. There is also the matter of Repo 105, an accounting practice the firm used to temporarily reduce its reported leverage at the end of each quarter by classifying some short-term financing as sales rather than borrowings. The Voluka's Examiner report after the bankruptcy concluded that this practice had been used to make Lehman's balance sheet look healthier than it was. By the time the firm collapsed, real leverage was higher than the reported number. Money, here, is the vulnerability. It is what made Lehman uniquely fragile to the shock that was about to hit. But money alone, without the housing crisis, would not have killed the firm. Goldman Sachs and Morgan Stanley had similar leverage and survived because they got through the crisis with government support. Bear Stearns and Lehman did not. Money, the structural vulnerability, not the trigger. Management here is real but smaller than the popular narrative makes it. Lehman was led by Dick Fuld, who had been CEO since 1994. Fuld was widely respected on Wall Street. He had taken the firm public after its 1994 spin-off from American Express and grown it into a major fixed-income house. He was also famously aggressive, hierarchical, and reluctant to dilute the firm's equity by raising fresh capital under unfavorable terms. In the months before the September collapse, Fuld had multiple opportunities to raise capital or sell the firm. Korea Development Bank discussed a strategic investment in August and September of 2008 and walked away on September 9th, citing terms. Warren Buffett had a brief conversation about an investment earlier in the spring. Bank of America and Barclays both discussed acquisitions during the final weekend of negotiations. Each of these conversations broke down on terms that in retrospect look stubborn. Fuld believed Lehman was worth more than the offers reflected. He pushed for higher prices for keeping more of the firm intact, for a better deal than the deteriorating market would provide. By the time he was willing to consider worse terms, the terms available were worse still, and then there were no terms available. There is also the question of why Lehman had built such a heavy mortgage exposure in the first place. The firm's commercial real estate and residential mortgage holdings grew sharply between 2005 and 2007, exactly the period when, in retrospect, an investment bank with sound risk management should have been reducing exposure. Internal risk officers reportedly flagged concerns. The flags were overruled at the senior level, so management mattered. The firm had options it did not take. The risk concentration was a choice. The decision to push for terms during the final weekend rather than accept the offer on the table was a choice. None of these choices were the deepest cause of the bankruptcy, but better choices in any of them would have produced a less catastrophic outcome. Management, real impact, real responsibility, but not the deepest cause. The moment force here has a specific shape. In March of 2008, Bear Stearns collapsed and was sold to J.P. Morgan with Federal Reserve backstops. That was the warning shot. Through the summer of 2008, the housing market kept deteriorating. In early September, Fannie Mae and Freddie Mac were placed into government conservatorship. The weekend of September the 12th to 14th, 2008 was when Lehman's options ran out. Treasury Secretary Henry Paulson and New York Fed President Tim Geithner convened the heads of every major Wall Street firm at the New York Fed building. The question on the table was whether the Fed would backstop a Lehman acquisition the way it had backstopped Bear's. The answer by Sunday afternoon was no. The official reason given for not backstopping Lehman was that there was no legal authority for the Fed to lend against the kind of collateral Lehman had. The housing assets had deteriorated to the point where there was no clean basis for a loan. Whether that legal argument fully holds up is contested. What matters for the framework is that the Treasury and Fed made a decision not to save Lehman while making different decisions for other firms. 2 days later, Tuesday, September 16th, the Fed extended an $85 billion emergency loan to AIG to prevent a similar collapse. Within 2 weeks, Goldman Sachs and Morgan Stanley had been allowed to convert to bank holding companies, giving them access to Federal Reserve discount window lending. Within weeks, the largest commercial banks received TARP capital injections. In other words, the moment that killed Lehman was the specific decision made over one weekend that this particular firm would not be rescued while others would be. That decision was driven by political calculation, by perceived legal constraints, and by exhaustion of the public's tolerance for bailouts after Bear Stearns. None of those forces was fully under Lehman's control. This is what makes Lehman's case moment decisive. The financial crisis was the exogenous shock. The decision to let this particular firm fail while others were saved was the trigger. Lehman's leverage and its mortgage exposure were the vulnerability that ensured the trigger would be fatal once pulled. Moment decisive. So let's grade them out. Market, superficially healthy, structurally fragile in a way few firms had priced for. Money, the structural vulnerability that made the shock fatal but not the trigger. Management, real responsibility for choices made and not made, but operating within constraints set by the larger crisis. Moment decisive. Lehman survived 158 years of American economic history because none of the previous shocks happened to be the specific shock its balance sheet could not absorb. The 2008 financial crisis was the decision over a single weekend not to extend the same support that other firms received determined that Lehman, specifically, would be the example. Here's the cross-episode lesson. The framework now has two moment cases, Nokia and Lehman, and the contrast is useful. Nokia was a slow moment. The smartphone shift played out over 5 or 6 years. Inside that window, Nokia made management mistakes that mattered, but the underlying redefinition of the product category was beyond what any leadership team could fully overcome. Lehman was a fast moment. The crisis trigger arrived over a single weekend. Inside that window, management could have raised capital earlier or accepted worse terms, but the underlying credit shock was beyond the firm's ability to control. What both cases share is that the firm's other forces, market, money, management, were not anomalous compared to peers. Nokia was a typical incumbent in a shifting category. Lehman was a typical major investment bank in a leveraged industry. What killed each was being on the wrong side of an external shift that hit the category broadly and picked off the most exposed firms. When you're watching for a moment decisive story, the diagnostic is whether the company's outcome is sharply different from peers facing the same shift. If Lehman had been the only investment bank in trouble in 2008, the verdict would have been money or management. The fact that Bear Stearns went down too and that Goldman and Morgan Stanley needed extraordinary support to survive places the cause outside any one firm's control. The moment did the work. That's the framework's answer to crises. Not every casualty of a crisis is a moment case. Sometimes the crisis just exposes a firm that was already broken. Lehman wasn't already broken. It was leveraged like its peers, run by a CEO with a long track record and in a market that looked profitable. The moment changed all of that in a weekend. Next case is the company that taught business school for 15 years and then went bankrupt anyway. A Circuit City subscribed.